India's finance ministry has released its latest monthly economic review, and the message is cautious resilience, not unchecked optimism. The numbers tell a mixed story. Strong services exports, healthy foreign exchange reserves and a stable labour market are giving the economy a solid foundation. But the report flags real risks such as elevated global energy prices, a depreciating rupee, rising upstream cost pressures and worries over a below-normal monsoon. Let's start with oil. Brent crude averaged $120.40 a barrel in April before easing to $108.30 in May. That's still a geopolitical risk premium baked into prices, with West Asia tensions the key driver. Lower oil helps India's import bill, but the relief is only partial for now, as the price is still above pre-war levels. Then there's the rupee. The currency has weakened roughly 4.9% since the West Asia tensions began. The finance ministry's only framing is interesting. The report argues the currency fall is not a sign of economic weakness, but reflects how global capital is concentrating into a narrower set of sectors and countries. In really effective terms, the currency had actually become overvalued by late 2024, making Indian exports less competitive. So the government suggests this correction has a silver lining for trade competitiveness. On inflation, the picture is more reassuring. Price pressures are likely being offset by base effects, meaning year-on-year comparisons are flattering even as month-on-month costs creep up, particularly in energy and transport. One bright spot worth flagging in the report is defense manufacturing. India's drone industry alone generated close to 3,000 crore rupees, or $316.6 million in the financial year 2026. And total arms export jumped 62% year-on-year to over 38,000 crore rupees. That is a sign of diversification beyond the usual growth engines. The bottom line is that India is not immune to global shocks, but it's absorbing them better than most. The real test comes in the financial year 2027, where monetary, fiscal and structural policy will need to move in to lockstep to keep growth on track and inflation anchored.